Welcome back to FX Limit, where we break down strategies and tools to make you a better, more informed Forex trader. Today, we're diving into range trading strategies that work especially well in sideways or consolidating markets, where price doesn't have a strong directional trend. Range trading can be incredibly effective, but only if you understand the right strategies to navigate these quieter, yet potentially profitable, market conditions. And if you're looking for tools to help make these strategies easier, stick around to learn about how you can simplify this process with tools like the Apex Trend Indicator, especially if you're tired of false signals and want clear guidance on when to enter or exit your trades. Alright, so let's start with the basics. What is range trading? Unlike trend trading, where we look for a clear upward or downward movement, range trading focuses on finding price levels where a currency pair is repeatedly bouncing between support and resistance. Imagine the price moving in a zigzag pattern, staying within a range or channel for an extended period of time. Traders use these established price boundaries to make buy and sell decisions, taking advantage of each reversal at the edges of the range. But here's the thing. Identifying a range isn't always as simple as spotting two flat lines on a chart. Markets often give us mixed signals, with some noise that can fake us out. That's why knowing a few solid range trading techniques is essential if you want to profit consistently in these market conditions. Let's walk through some of the top strategies. First up, we have support and resistance trading. This is the most straightforward approach to range trading. The idea is to buy when the price hits the support level, where buyers typically step in and push prices higher, and sell when the price reaches the resistance level, where sellers generally overpower buyers, pushing prices down. This strategy works because the price has historically bounced off these levels, and as long as the range holds, these bounces present opportunities. To make this strategy work even better, it's essential to wait for confirmation before entering a trade. For example, rather than entering a trade the moment price touches support or resistance, wait for the candlestick to close in the direction you're anticipating. This way, you're avoiding the risk of jumping in too soon on a price level that might not hold. And if you're wondering how to spot these levels quickly, an indicator like the Apex Trend Indicator can be a huge help. This tool can alert you when price approaches key levels on multiple pairs and timeframes, so you're not glued to the screen 24/7. Next, we have the Oscillator Strategy. Oscillators, like the RSI, Relative Strength Index, or Stochastic Oscillator, are great companions for range-bound markets because they help us understand overbought and oversold conditions within that range. When the RSI, for instance, shows the market is overbought as it hits the upper resistance, it's a good indication to sell. Likewise, if the RSI suggests the market is oversold as it touches the lower support, this might be a good buy signal. The key here is to use these indicators within the range you've identified, not in a trending market where they might lead to false signals. Oscillators are most effective when prices are bouncing predictably within a range, and that's why combining them with tools that confirm the trend direction, like the Apex Trend Indicator, can provide you with extra assurance. Apex can give you alerts when the market is primed for a turnaround, right at those critical support or resistance levels, making the combination of oscillators and trend indicators a powerful approach. Moving on, let's talk about the breakout strategy for range trading. Yes, breakout trading might sound counterintuitive in a range market, but here's why it works. Ranges don't last forever. Eventually, the price will break out above resistance or fall below support, initiating a new trend. Knowing when this is likely to happen can give you an edge because traders who catch these breakouts early often capture substantial moves. One way to trade breakouts is by setting buy stop or sell stop orders just outside the support and resistance levels. This way, if the price breaks out, your trade will automatically activate in the new direction. But remember, false breakouts do happen, so risk management here is crucial. This is where a tool like the Apex Trend Indicator can again provide value. Apex's high accuracy algorithm helps distinguish between genuine breakouts and false signals by analyzing the strength of the move, keeping you on the right side of the trend. And speaking of managing risk, always use stop losses. Range trading might feel safer because the price is moving predictably between two levels, but unexpected breakouts or economic news can disrupt that pattern in seconds. Placing a stop loss just outside the range can protect you from large losses if a breakout occurs against your position. Tools like Apex come with automatic stop loss recommendations based on market volatility, so you're not just guessing where to place your stop. The system's logic calculates stop levels based on support and resistance zones, keeping your positions as safe as possible. Now, let's touch on the moving average crossover strategy. This one can be a bit trickier in a range, but if you use shorter time frames, moving averages can still offer insight into smaller trends within the range. The idea is to use a shorter period moving average, like a 10 period, alongside a longer one, like a 20 period, and look for crossovers. When the shorter moving average crosses above the longer one, it's a buy signal, and when it crosses below, it's a sell signal. This can work well in tighter ranges, especially when the range has been established for a while. But here's a pro tip. If the range starts to narrow or if you're unsure whether the crossover will hold, check the Apex Trend Indicators dashboard for confirmation. The dashboard shows the current market direction and success rate for each pair and time frame, giving you a snapshot of market sentiment to guide your decisions. And finally, one of my favorite strategies for range markets: scalping within the range. Scalping is perfect for tight ranges, where the price bounces frequently within a narrow channel. The goal here is to make multiple small profits instead of holding out for a single big move. You'd enter trades near the support or resistance, setting tight profit targets and stop losses to capitalize on quick reversals. Scalping is fast-paced, but if you're using a tool like the Apex Trend Indicator, it can alert you when conditions are optimal for these quick trades, cutting down on time you spend monitoring the charts and giving you more opportunities to profit from each bounce. Range trading can be highly rewarding once you understand these strategies and apply the right tools. Tools like the Apex Trend Indicator not only give you a visual representation of the trend but also offer alert systems, multi-pair support, and a statistical dashboard so you're never trading blind. If you're interested in seeing how this tool can streamline your range trading, check out fxlimit.com for more info. So there you have it, the best range trading strategies for Forex. Remember, the key to successful range trading is patience, discipline, and using tools that enhance your trading insight, like the Apex Trend Indicator. If you found this video helpful, make sure to hit that like button, subscribe for more trading tips, and let us know in the comments what range trading strategies work best for you. Thanks for watching, and as always, happy trading.